The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Friday, and if it's Friday, we're going to be talking about money. So what a start to the year. What a start to the year. It's one of the worst starts that we've seen in years. It's a time when a lot of people were predicting this was going to be a solid year for the market, not a spectacular year, but a good year for the market. And what happens? China shuts down their stock market, and our market goes crashing down almost 400 points. They open it a couple days later, it's open for 7 minutes, and it shuts down once again, and our market goes down 400 points. What a start to the year. You know, we're going to be talking about that because we're going to have a lot of things going on this year. Richard Bernstein had an article in Financial Advisor magazine. I thought it was very, very appropriate considering all things that are going on. He talked about it's going to be a very difficult year for investors, but probably a good year for investing. Let me say that again. A very difficult year for investors, but probably a good year for investing. So what does he mean by that? Well, just think about it. We're in a presidential race. We're in congressional races. And what you hear in the debates are how bad the economy is doing, how many jobs are being lost. You hear about all the negative things, how bad the Obama administration has been, how bad things are, how workers are not seeing their incomes rise. You hear all those things. And as we go through the debates, I believe we're going to see a lot of volatility and people listening. Bernstein suggested the best thing to do is to mute the TV and look at what's really going on. I agree with that. I think it's going to be a very difficult year. We're going to hear all sorts of claims, which are not true. We already know from the fact checkers that not one of the candidates has been completely truthful, that many exaggerations and straight out lies have been told about what's going on. And we can expect that's going to continue until November and maybe beyond. So it's going to be a very difficult year. And if you listen to what's being said, it's a time of fear. You know, you can summarize a number of the candidates, their positions as saying, you should be scared, but trust me. You should be scared. Things are really bad, but trust me, I can make it all better. That's the kind of year it's going to be. But the important thing to focus in is not on what's being said, but what's actually happening. You know, guess what? The economy and business is not doing so bad. Look at Seattle. Look at the number of cranes that are going on and the amount of office space that's being built. We're one of the hottest markets in the country, but even throughout the country, we're seeing growth happening. And my guest today, you're going to hear more about some of that growth and some of what's going on the commercial real estate side. You want to hear what he has to say. That's later in the program. We'll be getting to that. You know, but just because people say things are bad doesn't make it really bad. Daniel Patrick Moynihan, one of my favorite sayings is, everyone's entitled to their own opinion, but no one is entitled to their own set of facts. The facts are what the facts are. And if I can convince you, the listener, of anything, it's to look at what the facts are and to look at what's going on. There's been a lot of talk about the deficit and the debt that's owed by the country, especially as we were in the Great Great Recession. During the Great Recession, we had this huge deficit, and people talked about the debt, and people talked about leaving the debt to our children and our grandchildren, and how bad it was. During the Great Recession, the deficit reached 10% of GDP, 10% of the nation's output. That's how much we were short on the deficit. You had expenses increasing, especially those in the safety net, because you had a lot of people out of work. You had unemployment going on. You had food stamps going on. You heard what was said and talked about the food stamp program, the unemployment, the extension of unemployment benefits. All of that was going on. And at the same time, expenses were going up. You had revenues going down because you had a slowdown in the economy. You had people paying fewer taxes. You had businesses paying fewer taxes. So you had revenues decreasing and expenses increasing. And that means the deficit grows. But now if you look at the deficit, it's not 10% of GDP, it's 2.5% of GDP. It doesn't mean we have to pay off the debt. If you look at it in terms of a home mortgage, it's like having a home mortgage and making interest-only payments. Only the difference is the government has a very, very, very long lifetime. It's not like an individual where eventually the lifetime comes to an end. 2.5% of GDP, that's where we are. And if you look at where we are in terms of long-term, we're better than normal. We hear all this talk about saddling our children with debt, but what's happening is things are getting better. It's, that's one of the things we're probably going to hear again and again and again. And it's going to sound awful, and it's going to sound terrible, and it's going to make some people want to crawl into a hole. The fact is, the deficit as a part of GDP is 2.5%. That's not bad. That's better than the average. And we also hear about workers and their compensation. Compensation's been flat for 3 decades. That's according to what's being said. But if you look at what's going on, consumer confidence numbers, the polls that they're doing, the surveys they're doing, we're finding consumer confidence is at almost record levels. People are feeling good. If you look at consumer debt, when we went into the Great Recession, we had an excess of debt. But after the Great Recession, as that rolled out, consumers deleveraged. They've deleveraged enough that average consumer debt is below what it was the 30 years prior to the Great Recession. Its consumer debt has been deleveraged and is in better case. Average hourly earnings, if you look at the last 12 months, average hourly earnings were up 2.3%. Now, that's not as good as the longer-term 3.6%, but it doesn't mean that earnings are flat. It doesn't mean that people haven't seen an increase. And if you take the purchasing power, what a dollar buys today, the purchasing power of a worker's compensation is almost at a record high at what we can buy. And think about what's gone on. Gas prices are way down. We're seeing inflation really, really at almost zero. You see and hear the Fed talking about what do we do about inflation because we're not seeing any. There's a concern that we're going into deflation. We're seeing, and I've talked in the last few months about commodity prices and what's going on there. I believe that that's a longer-term trend. If you listen to the previous programs, you know that what I talked about was all these things that are going on in the world are related to a burst of the credit bubble. Whether it's the price of gold, whether it's the price of oil, whether it's the price of any of the commodities, whether it's junk bonds, whether it's emerging markets, whether it's private equity or hedge funds, they're all related to the commodities bubble bursting, or the credit bubble bursting. There's an overcapacity. I started my career in the aluminum industry and at Intaco Aluminum up in Ferndale. And Alcoa now is shutting down the furnaces because there's an overcapacity, 23% overcapacity of producing aluminum. The same is true of steel. 600 metric tons, too great a production. There was all this concept because of derivative securities and futures contracts of people thinking that commodity demand was much greater than it really was. Most of the demand we were seeing was speculation. So if you look at the worker, we're seeing wages beginning to increase, and with unemployment at 5%, that's probably going to continue to increase. The average long-term unemployment rate has been 6.4, so we are lower than average. And when you have 10% unemployment, you're not going to see people getting wage increases. So we're seeing that happen, and it's going to continue to happen. If you look at small business, the National Federation of Independent Business does surveys, and they found that hiring intentions for this coming year are very, very high. Now we're going to come back. We're coming into a commercial break. Don't go away because I want to finish this. And then you want to hear what my guest has to say about commercial real estate. Don't go away. We've got more coming right after the break.
More about money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I've been talking about this article that was written by Richard Bernstein in Financial Advisor magazine, talking about a difficult year for investors, but probably a pretty good year for investing. Difficult because of what's going on in the presidential race, the congressional races, and they have their own agenda. Their agenda is to get elected. It's not to help out the markets. It's not to help out investors. It's to get elected. So remember that as you listen to things. And the facts are that the economy is doing well. I started talking about that. Let me finish that. And then I want to talk about some of the other things that are going on that will impact the market and make it a difficult year. We're already seeing that the first week of this year, but I'll get to that. Small businesses. National Federation of Independent Business does a survey. The survey of small businesses to determine what their hiring intention is. And they're seeing that the survey is coming back with a higher intention of hiring than the long-term average, hiring more than normal. Now, if things were really as bad as the politicians would have you believe, as some of the politicians would have you believe, small businesses would not be hiring people, or they wouldn't be hiring as many people if things were really that bad. But what they are, we're seeing that things are going well. Finally, there's the U.S. dollar. The dollar is continuing to rise, and the dollar and currencies in general are reflective of how well a country's economy is doing. We've seen our dollar rise against the euro. We've seen it rise against the Chinese currency, the yuan, the RMB. We've seen that happen, and it's probably going to get stronger as the year goes along. That's going to make it cheaper to buy imports. And already, because of what's happening with excess capacity in the world, excess production capacity, that's driving down prices, and that's going to make it a very good year for the American consumer and American businesses. So don't listen to all the noise that's going on. Focus on the facts, not the noise. But it's not just going to be the political situation. I think this week is really an indication of some of the other things that are going on, all related to this bursting of the credit bubble in China. Go back and look on my website. There's blogs about what's going on in China. They grew their economy very, very fast, from an agricultural society to the second largest GDP in the world. And they did that through mercantilism. I made the comparison a year or 2 years ago to Louis XIV in France doing the same thing. It's almost an exact pattern of what China did to bring their economy to where it was. But the Chinese economy is centrally planned. They set their priorities for what they want to happen. It's not adjusted to the economy. It's not adjusted to the markets. It meets the political aims of the politicians, the party members in China. And when you do that, you don't really get the demand and supply equation correct. A lot of times you overbuild. You end up with too much supply in one area, and in other areas, excess demand without the supply. So it's going to be one of those times. And I think that there's some parallels, because people get so excited about what was going on in China, and China is the great coming economy, and the things that are going on in China are going to move the world. To some extent, that's true. But the stock market in China, I believe, has been overinflated for a long time. And if you look at Japan's stock market, their index equivalent to the Dow, their equivalent to the Dow in 1987 was 35,000. Know what it is today? 19,000. 30 years later, almost 30 years later, it's not recovered to what it was in 1987. Will China take 30 years to dig their way out? I don't know. I don't know that it'll take 5 years. I don't know if it'll take 8 years. But I really don't believe it's going to happen in 30 days. But that kind of upset has a ripple effect throughout the entire world and the U.S. economy. There was a time, not that many decades ago, when the U.S. economy, the GDP of the U.S., was 50% of the world GDP. The U.S. GDP was 50% of the world GDP. Now, those emerging markets are 50% or over 50% of the world economy. When you have an impact like China, it is going to have ripple effects that affect the U.S. and in Europe. When you have those things going on in South America or in the former Soviet states, they are going to have an impact. But the focus has to be on what's going here and being invested in the right things at the right time so that it becomes a very good place to be. That's my insight for this week. And we're off to a great year in the market, a really bouncy kind of time. I can't say that it's really been exciting this week, but it is what it is. You know my outlook for the market. I talked about it the last couple of weeks, that I expect the Standard & Poor's to be up significantly to 2398. I put a number on it. First time I've ever put a number on it. And it's not going to be 2398, but I'll adjust that as we go along. But that's significantly higher than most people are forecasting. We'll see if they're right or if I'm right or how things are run. My guest today is someone that has great insight. He's been in the commercial real estate market for a long time, but I'm going to let him tell you about it. It's Jeff Lyon, the president of Kidder Matthews. Welcome to the program, Jeff.
Thank you very much. Good afternoon.
So, Jeff, why don't we start with your background?
Well, I've been in real estate since 1972, got into commercial real estate in 75, and have been doing that my whole life. I merged my little family company with Kidder Matthews in 91 to open up a Tacoma office, and was a broker out in the marketplace like the rest of them, and in 2000 I became CEO.
So you've seen a lot of changes since 1972.
Been a lot of change.
So tell us what's going on now in the Seattle and Puget Sound area.
Well, we're in a very fortunate market. We have one of the strongest commercial real estate markets really in the country. We're very fortunate to have tremendous job growth. We've got Amazon, we've got Microsoft, we've got Boeing, and then all of the spin-offs from that, which is really driving a lot of our growth. And look at how Amazon has transformed South Lake Union. And they've transformed it two ways, not only with the office development, but also on the residential side. When you look at all the people living down there, working down there, playing down there, it's really changed our locale down here.
I know I've driven down there a couple of times, and it's hard to recognize what's going on. And the roads have changed. It used to be easy to drive through on Westlake Avenue, and now it's really difficult.
Oh yeah, the thousands of people working down there, and plus they just announced, I think this last week, that they're going to be building their third tower, starting their third tower on the Denny Triangle, which is another 1 million plus square feet. So they're very thirsty for real estate.
So how many cranes are actually operating now?
Well, I think the last number I saw, there are 30 plus cranes, of which I think about 65% of them are for residential. A lot of condominiums, a lot of apartment buildings, as well as new office buildings going up all over the area.
And will they be able to fill all that? It seems like that's suddenly an explosive time.
Well, some of the cranes, the product isn't going to come online for another year or two. So, in fact, I just heard news of some of the cranes that are up in Bellevue, that about 1.5 million square feet, looks like about 700,000 square feet is committed. And we talked about a month ago when they were saying we don't know if there are any tenants for it. So we're starting to see absorption. We're starting to see some of the existing product that was here on the market being absorbed, because majority of the new stuff, South Lake Union, is being absorbed by Amazon and other tech companies.
So we talk about the tech companies, and there's something like 8,000 tech companies, from one or two people to the Amazons and to the Microsofts. So why are they coming to the Seattle area?
Well, we've seen a tremendous amount of expansion from the companies from Silicon Valley, whether it's Google, Facebook, Salesforce. They're coming up here because of the intellectual capital. They've got the engineers, and we've got a tremendous place to live, great quality of life, and they want to stay here. And if Google or the other companies are trying to recruit them, the only way to get them is to really open up an office up here.
That's incredible.
It has been amazing. And in fact, I think it was yesterday, announced the new project over in Kirkland with Tableau and Wave consolidating on the east side, which is going to be a major project for Kirkland.
That's the Park Place.
Correct.
Yeah. That's what, 40 years old, 45 years old?
Well, it's going to be a new development. Yeah, but it's
no, but it was first developed 45 years
right.
ago.
Right. They're going to rehab the QFC and then build new office buildings there. Talon is going to be doing that project.
It's amazing what's happening and transforming,
and that will change Kirkland. Think of that number of people just working there. A lot of them will want to live there, and so we've got a lot of development coming in the future.
So what are the incentives of people moving back and forth between the east side and Seattle?
Well, I think the incentive is that we're seeing a transformation of people wanting to work and live in the same area, which is creating opportunities for new restaurants. Everybody wants to live, work, and play in where they can, and they want to minimize their commute time if at all possible, because transportation, as we all know, is a big challenge for all of us. So you're seeing a lot of these companies that might have been centrally located on one side of the lake or the other. They're going to both sides now to really be able to address the hiring of the right personnel that they want to have.
And transportation is always going to be an issue.
And we don't have really a lot of solutions. It's going to take time.
Yeah. We're going to be coming back to a break. I want, when we come back from the break, I really want to talk about leases and negotiating leases. It is something that's really appropriate now with the amount of space that's coming and the new people that are coming into and needing space. So when we come back from break, let's talk about that.
Okay.
Don't go away. You want to hear what we have to say? And I've got another interesting thing about a movie that's playing. That's coming later in the program, so don't go away.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Jeff Lyons of Kidder Matthews. We're the CEO and chairman of Kidder Matthews. We've been talking about commercial real estate, a couple things that are going on, and we'll get to talking about leases. But first, let's talk about what's going on in cap rates and interest rates. Maybe we start by explaining what a cap rate is.
A cap rate is a relationship between net income and value. As here's an example. Let's say a piece of property, income property, has $100,000 net income, and you wanted a 10% return. That means you're willing to pay $1 million for that property, thus a 10% cap rate, the relationship. You take that same $100,000 and you're saying, I'm willing to use a cap rate of 5%, that'd be $2 million. Same property, same income stream, same tenants, but the investor was willing to take a 5% return on that income instead of a 10% return. And we'll see in the marketplace all across, you'll see numbers all across the board. And depending on product type, depending on location, depending on the quality of that income stream, you'll see a wide range of cap rates. I saw recently cap rates on multifamily, sub 4.
Lower than 4.
Lower than 4%.
Why are we seeing that? You know, I know long-term rates are down in the 2s if you look at the treasuries.
That's the reason why right there, is that they're people who have capital sitting somewhere. What kind of return are they getting? And so they're saying, I want stable income where I'm willing, and as long as I can get a higher return based off the risk, that will determine what kind of cap rate I would like, that I'm looking for. And there's a tremendous amount of capital out there in the world right now, of which everybody wants to be in Seattle, if they can. In the core, we're seeing record low cap rates, record high values, record high on a price per square foot. And the income stream really hasn't changed much. Still the same income stream. It's just the amount of return that somebody is willing to take. It'll be interesting to see what happens 3, 5, 7, 10 years down the road when they try to sell those properties, depending what's happening with interest rates and what's happening in the financial markets and whether or not they have debt on that property.
So if interest rates actually begin to go up, and most people think that they will eventually go up, what does that means? Cap rates go up, which means the price of the buildings then goes down.
Yes, in some cases. The interest rates that just went up were short-term rates. We're still seeing long-term rates because of the 10-year treasuries that you can still get sub-4 interest rates on certain types of products. But if you were to go out and buy a commercial building, leased investment property, up to maybe $5 to $10 million, you're probably going to be 4.25%, 4.5% interest rate. So if you have a cap rate of greater than 4.5%, that means you have positive leverage. That for every dollar you put in is going to actually increase your rate of return.
Yeah. And I believe that interest rates on the long term are set by the market, and they're not going to be, we've got a ways to go. The dollar gets stronger and stronger.
Right. And what I'm hearing out in the market and from the financial banks and institutions, it's out there till for another 18 months to 2 years before long-term rates start really rising.
I believe that's probably true.
Right.
So let's talk about leasing and what goes into determining what the lease should be, the tenant improvements.
Well, in this environment, it's all negotiable. Obviously, it has to do with your own planning, your own company planning. What are my needs? We have seen changes recently because of technology of how a lot of the users are taking less square feet per employee. Used to take a law firm, for instance. They might have 450 to 500 square feet per employee. So you have 20-person office, 500, that's 5,000 square feet. Because they used to have the big libraries and things like that. Well, everything's on the servers now. You don't need all that. We're seeing those same tenants shrink down to maybe 250 square feet. So the traditional service companies, we're seeing them take less square footage. The tech companies, we've heard of some of them, Microsoft, Open Landscape, they might be down in the neighborhood of 100, 150 square feet. So that's having a lot of impact on how space is being used, the tenant improvements the tenant might need, and then that's going to drive the financial characteristics of that lease. You have base rent, you have operating expenses, you have tenant improvement allowance, who's going to pay for them, how is that amortized over the term of the lease. And the advice I'd give smaller tenants, businesses today is you cannot go out early enough to start looking at space if you're outgrowing it, because it's getting very expensive. It takes very long to build new space, so you need to understand what's available in the market. And if you miss that window, depending on when you leased and the cycle that you're in, you want to see when's the right time for your own business to start negotiations.
And I think it's even worth looking around before you get to the 18 or 24 months to look at what's available today.
Well, it can change very quickly. So I think, if you're 12 to 18 months ahead of time starting to look, or, working with somebody who knows what space is going to be coming available, maybe in the next year, 18 months, because that company might have outgrown their space and they're moving to a new location because of the construction going on. You need to deal with those who understand the local market.
So what does a local person bring to the table?
A local broker?
A local broker.
Broker's going to bring knowledge. It's about market information. There's a lot of property information that's available because of technology. But there's a lot of stuff that you need to interpret that information. But also, there's a lot of transactions that are being done that isn't readily available. It's about knowing space of a tenant that might be downsizing. You just saw, I saw some Twitter down in San Francisco is subleasing their space. This wasn't space that was on the market, but we just heard about a tenant taking over some of their space because the broker was knowledgeable about what the plans of an existing tenant was. So you need to be aware of all market conditions.
But it goes beyond just the market conditions, too. It goes into the negotiation as well, right?
Well, that's what really drives the negotiations.
Okay.
And depending on the cycle, knowing when the landlord or the owner of the property bought their property and financed that property, and determining if somebody financed or bought the property in 2007.
Okay.
In all likelihood, their debt is going to come due in 2017. And if you're trying to negotiate a lease, or they're trying to start the refinancing process, they're going to want to make sure that the tenants have longer leases so that the underwriting on the loan is going to be better than if they had short-term leases.
And also if they're trying to sell the building.
Exactly.
So that's something that, is it public information?
Most leases are not public, and they could be recorded, but the terms and conditions are not going to be vetted out there. Like on a sale, on a sale where a deed changes hands, you're able to get the sale price.
So in terms of moving to a new space and looking at tenant improvements, you mentioned before when we had lunch that the tenant improvements can be, or the lease rate can be based on several different factors.
And that's really a function of the market, about availability of space. And when there's a surplus, go back several years when the vacancy was in the double digits, landlords, and there are only so many tenants out there looking for space, you're going to, as a tenant, get a larger tenant improvement allowance than maybe if you were, in today's environment. It's becoming a landlord's market today because of the lack of space, because of the growth and the strength of our economy. Companies are growing, taking more space. And just because the landlord says, I'll give you $25 or $50 a square foot in tenant improvement allowance, depending what your plans are for that space, you might need $75 to $100 a square foot. So now that's where the negotiations come into play. Who's going to pay for those? As a tenant, if you're large on capital, maybe you're willing to put those in to keep your effective rate down. On the other hand, if you're a strong tenant, but you don't have a lot of capital, but you have a lot of operating capital to use, maybe the landlord's willing to put in additional TIs and amortize that cost of that over the term of the lease. The challenge there for the tenant is if the landlord does it, he's going to want a return. He's going to want a return on his capital, which is probably higher than your cost of funds, which means having them do it will cost you more than if you do it yourself.
So these are all things that are open with an agent. He'll go through this. And
they should go through it.
Okay.
They should.
So if someone's looking for lease space, if someone is looking for someone to walk them through this, how would they get a hold of you, or how would they get a hold of someone at Kidder Matthews?
You go to kiddermatthews.com, and if you're depending on the product type, you can come online and or call me directly, and I'll put you in touch with the right broker in the right marketplace who understands the market, and they'll walk you through the process. And a lot of cases, there's going to be two sides to a transaction. If you're looking for space, you're going to want somebody who understands tenant representation. If you're looking to sell a building or lease a building, you're going to want somebody who understands the landlord representation side, because they're both sides. Obviously, on the tenant, you want to get the best deal possible. On the landlord, you want to get the best deal possible, which is usually higher than what the tenant wants to pay.
So again, the website is?
kiddermatthews.com.
And your phone number is?
206-296-9600.
Great. So if you're listening and you need space or think you might want space, do give him a call. You'll be well worth it. We'll be right back after this break. Don't go away.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So as we go through this program, we're tweeting at the same time. We're sending out tweets talking about the program, and we got a response to one of the tweets. And I have to talk about this. The tweet came back saying that I'm talking about the wrong thing when I compare debt to GDP. It says it should be compared to income, not GDP. The debt should be compared to income, not GDP, because Congress doesn't own the GDP. And there's a point to that. there is a valid point to that. If you're an individual, what determines the amount of debt you can handle is the income that you have coming in. And in most cases, you can't have a complete control over the income that you have coming in. You can't just say, I need more debt, so I'm going to raise my income. I have less debt, I'm going to decrease my income. So in comparing debt to income, there's an analogy with individuals, but individuals have a very finite lifetime. We don't continue to go on and on and on. The reason we use GDP is because the government has a lot of control over the income. They only need to raise taxes to increase their income. Take the tax rate on the top level from the 39 or 38% or whatever it is. It's too high, but anyway. Take it to 50% and you increase the income. It comes back to the Laffer curve. If you've talked about the Laffer curve, it goes back to Reagan days when you talk about what happens. If you have zero taxes, you have zero money coming into the government. If you tax at 100%, you have no income coming into the government because no one's going to work if they have to give all the money to the government. So you have this upside down U curve. And it depends upon where you are on the U curve determines the amount of income really coming into the government. You can raise taxes if you're on the upside of that curve, and you'll increase your income. That's what happened during the Clinton administration. They increased taxes, and they were able to balance the budget. On the other hand, if you look at during the Bush administration, we appeared to be on the downside of that curve, so that when they dropped taxes, they did not get an increase in income. So it goes back to GDP. They don't have control over GDP. GDP is what the economy is producing. And if you get increases in the economic activity, generally holding tax rates the same, you increase your income. And if activity slows down, you decrease your income. So there's a valid argument to say and compare the debt to GDP and not to income. Now, if that's not completely confusing, I don't know what is. But anyway, I agree there's a point, and it makes sense with the analogy of individuals, but it makes more sense to me to compare it to GDP because that's something Congress doesn't have control over. That's something that is a function of how well the economy does, and in the long term, that will determine how well we're able to pay off the debt, not necessarily the income. Anyway, I want to shift and talk about the movie. Nominated maybe for Best Picture of the Year. It was a fun movie to go see, The Big Short, based on the book by Michael Lewis, and talked about some people that made a huge amount of money on the Great Recession and the short. So to understand, it's a very complicated situation. And people that were at the movie didn't understand. Even as the movie tried to make it simple, they brought in Anthony Bourdain to explain things. They brought in other people to make analogies to what goes on. It's still a very complicated thing. What is a derivative security? It's one that's not direct. If you own a stock, that's ownership in a company. If you own a mutual fund, that's a derivative kind of security. You have airlines that will go out and buy futures contract on oil, for example, when they think oil prices are going up. Or you have gold mines that are mining gold will sell their gold a year to be delivered a year from now at a slightly higher price than the current price, or they hope. Maybe it doesn't happen these days, but that was what was going on. So you have derivative securities, and that's what got started with this whole thing. It started actually during the savings and loan crisis in the mid-'80s. Savings and loans and banks bring in money on a short-term basis, and they loan it out on a long-term basis, whether it's for housing, whether it's for business. They're loaning the money for a period of years. We talked about commercial real estate and 10-year financing. That means the banks are bringing that money in on a short-term basis. They're paying you for what you deposit in the bank. They're paying you short-term, and they're loaning that money out long-term. And usually that money's illiquid that's loaned out. But when the savings and loan crisis happened, remember what was going on in the 70s and 80s. You had very high rates, and rates were coming down, so that they were loaning money at lower rates than they were having to pay for depositors. They were losing money hand over fist. And the savings and loan business died. The savings and loan companies died. So that meant there was a shortage of funds to finance housing. And so you had Solomon Brothers and First Boston put together for Freddie Mac a collateralized mortgage obligation. What they did is they went out and decided, and maybe I can make it simple enough, if you're building a collateralized mortgage obligation and you happen to have 100 mortgages which are each worth $400,000, you bring all those together, put them into a pot, and you now have $40 million. That's 100 mortgages at $400,000 each. Now, just to be sure, some mortgages are going to default, so you add an extra 5. So you really have $42 million actual, if everybody pays off their mortgage, $42 million in principal, and they're going to pay interest on top of that. So, and then you divide. You assume that you're at $40 million, and you divide it into $1,000 units. So you have 40,000 bonds at $1,000 each face value. Interest and principal are paid, and an extra 5%. So if everybody pays off, you get more money than you put in, plus the interest. And through that, they were able to raise money, and it was something that was positive for home builders. It was something that was positive for the government because it continued the housing market. It was positive for home buyers because there was loan money or money that they could borrow to build houses. And then the idea came along to put it into tranches, making it long-term, short-term. And in the wisdom of Wall Street geniuses, they decided that they could combine that one that we just talked about, all the short-term tranches, all the short-term money, into a synthetic CMO. And they began to build synthetic CMOs. And now you have principal and interest, so you can break apart those again and make other synthetics. And then normally if you have someone that doesn't have a lot of credit, the banks will have them buy mortgage insurance. So they did the same thing. If you're not sure about your CMOs, you need insurance. So they created credit default swaps. And because they didn't want to be regulated by the insurance regulators, they called them credit default swaps, not CDO insurance. And that's what it was all about. And when the houses began to tumble down, when the dominoes fell, everything fell. There's a lot more complicated to it, and maybe next time I will get to in more detail. It's a great movie, it's a great book, and it says a lot. But for now, that's About Money, and I'll be back next Friday. Have a great
You've been
week.
listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing.